Good evening. Thank you for that very kind introduction, Madam Vice Chancellor, distinguished faculty members, my friend Abhijit Banerjee, Mrs. Banerjee, and dear students. It is a privilege to be here speaking in honor of a very beloved faculty member of this university. Academics typically have influence much wider than their particular narrow areas, but also long after they have stopped teaching, and in this case passed away, through their students and their students' students and so on. So it really is a great honor to be speaking in this lecture. Now, I had to find something to talk about that was not controversial, because Parliament is in session and it's usually not useful to create additional controversies. Also, given that this is a lecture in honor of a great professor, it's important to have some content, something that hopefully reflects thought and perhaps make you think. So what I want to speak about today is really debt, the role of debt in a free enterprise economy, and talk a little bit about how it is both essential to free enterprise as well as the source of some of the biggest calamities that can happen in a free enterprise system. Why, in a sense, taking on debt is a Faustian bargain, where societies sell their soul, but it's almost necessary to advance. There's a very interesting book that came out last year by David Graeber. It's called Debt, the First 5,000 Years. Here's a sociologist / anthropologist who's talking about the role of debt in society, and for many economists, I think it's useful to look at how other people see debt. But he reminds us that 1,000 years ago, money lenders, they were called usurers in the West, were people who were hated, and some would say they're still hated around the world. Today they call bankers, but this is something that has been there through much of history. Sermons of church of priests 1,000 years ago in Europe were full of horror stories about how God's judgment would fall on unrepentant lenders. Stories of these rich men being struck down by madness or terrible disease, haunted by nightmares of the snakes or demons who in hell would soon eat their flesh. So the idea was lending for interest was a terrible thing, and those who committed this, who indulged in this practice, were really bad people, terrible people. In fact, the Pope issued instructions to local parishes that all known usurers were to be excommunicated, they were not to be allowed to receive the sacraments, and under no grounds, under no conditions could their bodies be buried in hallowed ground. And there are stories of this kind which reflect the kind of contempt that the lender was held in. One example, there was a French cardinal who told a story about a particularly influential money lender whose friends, after he died, tried to pressurize the parish priest to overlook the rules and have him buried in the local churchyard. And since these were very influential friends, the priest said, okay, let's see, we'll put his body on a donkey and see God's will and what he'll do with the body. Wherever the donkey takes the body, be it a church, a cemetery, or elsewhere, there I will bury it. And the body was placed on the donkey, and the donkey, without deviating either to the left or the right, took it straight out of town to the place where thieves are hanged from the gibbet, and with a hearty buck sent the body flying into the dung below the gallows. So this is what was thought of the lender at that time. Of course, just before the financial crisis, we lionized the banker. I would presume that dowry rates in India, which are a very good example of the status of different professions, were very high for foreign bankers, people who had a good job in Morgan Stanley or Goldman Sachs. I would presume post-financial crisis, those rates have come down somewhat. But certainly in the West, if you look at business schools, the most sought-after profession was that of a banker. Many of our students at the Booth School used to go there. Today, not so. Today, probably the most sought-after job is that in some of these startups, and a close second is consulting. Why the change? And the change is not just now. You see the change in societies over time. Usury was condemned by the church in the 12th and 13th century, but not in the 14th and 15th century. And it was condemned again in the 16th and 17th century, but not afterwards. So why is it that we have this ambivalent attitude towards debt? Why do we favor it at some times? Why do we hate it at other times? And the reason, to some extent, is debt is very much like dynamite. It's an instrument which is very useful in the right places, explosive in others. There is always a temptation to overuse it because it's so easy to use, and sometimes very warped incentives to use it. However, despite these difficulties associated with debt, banning debt is typically not an option. The right answer typically is, can we get moderation? And for a regulator like me, can I regulate moderation even in the face of very strong political economy reasons to throw caution to the wind? Massive clamor to reduce interest rates, to ease capital requirements, to facilitate lending in a very big way in good times, only for society to pay the price in bad times. And the real question is, can we moderate the pressure in the good times, do only so much of it as is necessary so that we don't face terrible times. So let's ask, what are the characteristics of debt that cause this kind of both benefit and problem? Now, think of what debt replaces. Typically, in more primitive societies without an enforcement structure, what you really have is favors. I do a favor for you, and following a broad norm of reciprocity, you keep that in mind as a debt you owe me, and you repay the favor sometime down the line by doing a favor for me, right? So somebody in a village who has a harvest of say, ladies' fingers, will take some of the excess and spread it around, give other people. And those people, when they have their harvest of apples or they have their harvest of pumpkins, will give back some of those. But this kind of favor, mutual favor, is a way of building social bonds. And over time is a source of social insurance also. When you run short and you have nothing to give, still the village may look after you and repay some of these favors. What debt does is make all this very explicit. It says, I will repay you thus and such amount at thus and such date, and if I don't repay you, you have some power over me. You can seize some assets, you can put me in jail. In the days there were debtors' prisons. Basically, you can find forcible ways of getting it back, and these things are typically enforced by an external party. So one of the benefits of debt is it's a clear obligation, it's not fuzzy. And it is enforceable, so I don't have to rely on your continued goodwill. I can be as nasty as I want towards you, you still have to repay the debt. Unlike with a favor, where if I do a favor and we fall out, you don't have to repay the favor down the line. So this means that there's very limited mutual dependence. I don't have to depend on you I don't have to depend on you or depend much on your performance, because typically debt is secured, debt can be forcibly repaid. Now, one of the advantages of debt that has been extolled in recent literature is because it's such a hard security, because often it is short term, sometimes it's runnable. It means I don't need to know very much about you, I don't need to trust you very much. I don't need to know very much about you because no matter how well or badly your business does, because I'm secured by, for example, the land that your business stands on, I can get repayment. I don't have to know what your business is. I don't have to have any faith in you as an entrepreneur. Right? So the value of debt is that we can be really distant from each other, both in information as well as in social terms. And debt still flows between, I give it you up front, you have the resources to conduct your business, you repay me at the end. I mean, think about one of the most famous creditors in history, Shylock from the Merchant of Venice. I mean, what was his method of enforcement? It was a pound of flesh. And therefore, he could lend to somebody he hated. In fact, of course, in the play, it's about him actually wanting to get that pound of flesh rather than getting repaid. But it was an enforceable contract between two parties who had absolutely no empathy for each other, right? And typically you find that in many communities, the lender, the creditor, the Shylock comes from outside the community, because that's the only way they can have the dispassionate ability to recover, regardless of the situation of the borrower. And it is that ability to recover under any circumstance that in fact allows them to lend up front. And this is something that people sometimes don't understand fully in India, right? That by making it hard for somebody to recover, we make it harder for somebody to lend in the first place. That enforcement of debt is necessary to get the lending in the first place. If you think that lending is good, you should be willing to enforce that contract. We have it in our regulations, for example. Sometimes we say you cannot take collateral against this loan. If we say you cannot take collateral, the incentive for the bank to lend is so much lower, because it's not sure it will get repaid. It has no ability to enforce the repayment. So by saying you can't take collateral, we feel we're doing the borrower a favor. Yes, we're doing a favor to those who can get loans. But those who can get loans are far fewer than those who could get loans if we allowed collateral. Okay? So this is an example of where this kind of thought comes in, that it is the ability to enforce the debt contract that allows the other side to borrow up front. And typically, the shorter term the loan, the more collateralized it is, the more my ability to take the money and run rather than wait in a bankruptcy court to get the money back, the more willing I am to lend. Now you see already the contours of the problem with debt. That the easiest contract to borrow against is usually the hardest contract. Which means that the advantage on the one side is I can get resources when in need. Okay? Many of our poor people find it very easy to borrow from the moneylender, because the moneylender has so many sources of recovery, some legitimate, some illegitimate. But they have so many more sources of recovering than perhaps the formal banker. So with debt, You can raise money easily. You can raise money without contacts. That's a good thing. I don't need to be embedded in a rich society to be able to borrow in that society. I don't need to have rich friends. I just need to know who's a rich money lender and go to them. They will be willing to lend to me because they know they can break my legs if I don't repay. That's their source of enforcement, right? So the good thing about the debt contract is it works in transferring resources to those in need, and it can transfer. The more anonymous the money lender is from me, the more liquid the contract is in his hands, because his ability to exercise power over me can be transferred to some other person. He's not recovering because I know him and I'm friendly with him and I'm going to repay him. In that case, it's a very illiquid contract. The only reason I'm repaying him is because he's my friend, not because the contract is enforceable. But once the contract is enforceable, it assumes a liquidity of its own. He can sell it to somebody else when in need, which again gives him greater incentive to lend to me in the first place. So the liquidity of the debt contract is another feature that is very beneficial. And the most important thing is outsiders can lend. So it expands the market for loans tremendously. Okay? So these are a bunch of reasons why the loan contract is very good. If you look at history, there's another reason why loan contracts are very effective. Because they're a formal commitment to repay over time. Basically, I can promise a whole stream of rents to the lender who's giving me money. I mean, this is how initially the Bank of England started. The Bank of England got a monopoly over the banking business in the United Kingdom. In return for that, it essentially paid a large sum of money to the UK government, to the British government at that time, the British King. It was essentially buying the monopoly by paying up front, but it knew that over time the lending business would generate rents over time, right? And those rents could be paid out, okay? So therefore, it could borrow money from the public against the future rents it would get. It could commit to repay the public. That was the borrowing that it did up front. Take that money, pay the UK government for the privilege of being able to get that monopoly. So debt facilitated this transformation of a monopoly over banking into current revenue for the government. And that was because the public could trust they would get their money back from the Bank of England over time because they had a debt contract, long-term debt contract against it. So if you think about corporations, corporations can borrow over a long period, pledging a lot of value. They can borrow 30 years against a power plant today. Or 25 years in the 525 rule that we have here today. Because the power plant is going to generate revenues over 25 years, it has a debt contract, it has to repay the lender, and that allows it to borrow really long term beyond the lives of anybody running the plant today. So debt allows entities to pledge larger sums out of future value, especially long-lived institutions. Last point I want to make before I go to the disadvantages of debt is debt also, to the extent that it is long-lived, it also gives me an incentive as an entity issuing debt to commit myself to doing good things into the future, because the more I commit myself to doing good things into the future, the more I can borrow today against my future value. So think about countries. How can countries borrow today? They can borrow because they promise the person lending to them that over the long run they will repay, and in fact they commit to that repayment through the right kinds of governance structures, etc. Now let me go to the disadvantages of debt and then come to the trade-off, right? Graeber's most important criticism of debt is it kills communities, and that's a fact. When we do favors for each other, these are implicit commitments to each other, we build community. I know I can rely on you in times of trouble. because I've done favors for you, you've done favors for me. It's a kind of social, implicit social insurance. But once it's an explicit debt contract, you don't feel any sense of loyalty to me over and above the debt contract. There's an explicit claim. These bonds, which can be called upon in times of trouble, are not built. So instead of the favors which bind community, we get debt which is resented by the community, which makes the bonds between people much weaker. That's one of the concerns about debt. But of course, the flip side of this, the flip side of the anonymity introduced by debt is it expands the market. It allows people from outside the community to come and lend, which can allow the community to flourish more effectively. See the trade-off? It reduces community ties, but expands the resources the community can get. The big criticism against debt in the church canon, as well as in Islam today, is that because it's such a hard contract, the lender really doesn't take any risk. The lender is not participating in the enterprise, essentially extracts his pound of flesh without putting anything at stake except his money, and the borrower takes all the risk because the borrower, if the enterprise fails, essentially loses everything while the debtor goes away whole. This is the criticism against debt, which is why Islam often requires sharing. Interest-bearing contracts are prohibited in Islam, while sharing contracts are much, much praised. But of course, if you look at this carefully, certainly equity-like contracts may be better from the sense of sharing the risk, but they may be harder to write, because when you write a sharing contract, you have to know what the other fellow is doing. You have to know his business. You have to trust him. You have to trust him to run his business. The anonymity which is embedded in debt is no longer there, which then brings in all the disadvantages. You have to have much more information. You have to have much more trust. And it is very hard for really arm's-length outsiders to come and lend. So, yes, equity would be a better contract to share the risk, but it would diminish the capacity of the person who wants to start an enterprise from getting resources. It would reduce his capacity simply because the person who's sharing the risk will want to know much more, will want to have much more trust. The biggest criticism of debt that sometimes is levied is it makes promising very easy. And therefore, dictators can promise away the future of their country by borrowing enormous amounts and subjecting their countries to perpetual servitude because of the debt they have built up. There's a whole literature now which is built up on what is called odious debt. That is, perhaps we shouldn't enforce contracts when a dictator borrowed to finance his arms build-up or to finance grand projects which never played out. Similarly, in India, where we have a tradition of the son repaying the father's debt, we've always had a lot of concern about debt bondage. Maybe the father hasn't thought enough about his children and therefore borrows too much and subjects them perpetually to bondage. Of course, these kinds of concerns really mount to the fore when the current generation really does not care for the future generation, when the dictator doesn't care about the future of his country. But I think the real concern in these kinds of situations that public commentators really have is that debt in a situation of unequal bargaining allows excessive promises. This is always the Indian concern about the money lender. You go to the money lender when your children are starving, when your harvest has failed. At that point, you're willing to promise almost anything. And if you write a debt contract under those circumstances, that debt contract can be very, very onerous. So there are two things embedded in here. One is, of course, you're in great need. But the second thing is you're in a situation of monopoly. That who you have to borrow from, there's no competition. There aren't others who come in. Because he's one of the few guys who knows about you, who has the enforcement power in the community. That's why you don't find comparative moneylenders in many communities. There are a restricted group of moneylenders who collude with each other, because if they got into competition, it would be much better for the borrower, but also the rents to the moneylender would be far smaller. This is why in community after community, when there is a high probability of distress, there is a great aversion to debt contracts, and these often are prohibited. In fact, there are studies talking about, I told you the church had different views about money lending over time, and if you track that, it has something to do with the riskiness of agriculture over those periods. In periods where agricultural holdings were small and agricultural incomes were fluctuating a lot, at that point the church got very nervous about money lending, because the money lender would go in times of drought, in times of stress, and essentially extract everything from the poor farmer at that point. That eventually caused social unrest, caused revolution. It was not something the church liked. But after the Black Death, for example, in the 14th century, because so many people died, land holdings were much bigger, especially in certain parts of Europe. And the peasant was much better diversified now, larger plots of land, better ability to grow crops without adversity. And at that point, the church's attitude towards money lending changed. It became more favorable. Of course, there's a lot of controversy about this kind of debate and what the actual factors were, but certainly it seems reasonable to think that in situations where people at large are in situations of stress, society is much less favorable to lending and much more favorable to sharing contracts than otherwise. So unequal bargaining, historically, unequal bargaining in situations of limited competition in lending has been one reason why we've been unfavorable towards debt. More recently, a big factor against debt has been what we call moral hazard. And the reason here is that because debt is such a senior contract, because I don't have to think twice before lending, I'm willing to lend into situations where it doesn't make sense to lend. When the borrower is over-borrowing, is borrowing too much from many borrowers, we all think we'll get our money back. Eventually some of us won't, but we also hope that because we are all over-lending, either the government or the IMF or somebody else will come in and bail us out. So we lend to excess. That is a more common situation. So the first situation was a situation of monopoly. Second is a situation of excess competition to lend, where multiple lenders come in, many of them assuming that they will be able to get their money back, and sometimes lending knowing that if they try and recover their money, somebody will come and bail them out because they don't want to see a downturn. One example of this in the Indian context, I sometimes think, is external commercial borrowing. Indian banks make loans in a system where bankruptcy is relatively slow, relatively difficult. So Indian banks often are willing to negotiate when the borrower is in difficulty because they have to, going through bankruptcy is very painful, not going to happen in finite time. But if there's a foreign lender who's lent to that same promoter in a situation where they can go approach the London courts or the New York courts, which are much faster, much more effective, they have a very strong threat in case they're not repaid, which is, you promoter, I'm going to seize your assets in London or I'm going to seize your assets in New York by filing for bankruptcy there. And then the promoter who has no money or claims to have no money then goes to his bank, Indian bank, and says, look, they're threatening to take me into court, this will create disruption, will ruin my business, but you care about my business, why don't you pony up some money so we can repay the foreign lender? So effectively, the ECB has a super senior claim, even though it may be unsecured and it may not be something that has high priority. There are some stray instances of this happening. I don't want to say this is a general case, but this is an example of a situation where a lender comes in and makes further loans, knowing fully well they can get out ahead of the rest. And that creates a kind of moral hazard, which again promotes overlending. And finally, one of the big concerns about debt has been post-financial crisis, when a number of countries have been growing very slowly. And the argument here is the very slow growth reflects what is called a debt overhang. That is, the creditor who has made the loan doesn't want to write down the value of the debt because they keep hoping that there'll be some way they will get repaid. And in the meantime, the borrower, seeing this very high debt load, basically says, what's the point of doing any improvements in my business or improvements in my house or maintaining my house when ultimately this is not going to belong to me, this is going to go to the lender. So essentially they stop activity or they slow down an activity, which can then lead to much slower growth or much more distressed assets. Classic example in the US is borrowers who are deeply underwater basically trash their house. They take out every fitting, they stop maintaining it, they stop cleaning the lawn or mowing the lawn, simply because it's not their house anymore. It belongs to the bank. And therefore I have no incentive to maintain. That is what is called debt overhang. Ideally, the bank should recognize that the borrower has no equity and therefore is going to mistreat the property under the borrower. They should either seize the property or write down the value of debt. Typically, they end up doing nothing. And as a result, the property festers and gets worse over time. So when you have little ability to forgive and the borrower has little ability to pay, essentially you have a situation where the borrower has little incentive to invest in the property or the firm, and you have very, very slow growth. Some people argue the slow growth post-2007 is a reflection of this facet. So, what I've described as the advantages of debt, much more of it available from third parties whom you don't know. So it facilitates free enterprise. It facilitates anonymity, which is good because if the only people who succeeded were those with connections to rich people, it would be problematic in society. So it allows a level playing field. Downside, you tend to use too much of it. It's a hard contract. You tend to get into trouble. The lender typically doesn't do the efficient thing, and you have a lot of distress. So what do? How do we break this? And I would argue that many of the ways we have of making debt friendlier basically hit at the very benefits of debt. For example, courts in the past have done selective debt waivers. Even in India, we have had debt waivers. Farm debt has been waived on a number of occasions. But repeatedly, when these things happen, you see that the consequence of this post-waiver is actually lending falls off considerably. Andhra Pradesh, you had microfinance overlending to borrowers. Essentially, we had a massive waiver when the Andhra Pradesh government basically said, don't repay. Effectively, that was what happened. A lot of microfinance firms got into trouble, but the net effect is lending essentially dropped off to close to nothing in the years that followed in Andhra Pradesh. So you have to weigh these selective waivers, these waivers against the longer term consequences, which is lending drops off. Now, in the United States, they've actually had some very interesting waivers in the past. In the 19th century, there used to be situations where there used to be massive droughts, lots of farm losses. Farmers could not repay. When this happened on a wide scale across the country, what they did was brought in a bankruptcy law for a few years so that the farmers could, under the bankruptcy law, get a debt waiver. get the debt written down or waived completely. But then after that emergency was over, they repealed the law. So there was no law to allow for bankruptcy. And lenders now confident there was no way that their debt would be waived again until there was a countrywide national calamity, were willing to lend once again. So they tried to manage the trade-off between a hard contract and a soft contract, essentially saying in times of global calamity we'll make it soft, but in normal times it will be hard. And therefore they got the benefits of debt without too much of the costs. Now, there are other ways one can think about this, but in general I would say there is no simple answer. That essential to what debt does is the hardness of the debt contract, and the harder the debt contract is, the more you can borrow. There's a lot of talk going on amongst academics that, you know, this whole leverage in the banks was not particularly useful. And I agree that 50-to-1 leverage in some of the banks was simply too much. But at the same time, they go to the opposite extreme and say there's no advantage to debt. We could have banks that are fully equity funded. And I would argue that is complete nonsense. That you cannot get banks that are fully equity funded and have the kinds of costs of finance that you could have with banks that have substantial leverage. That's why we have banks with, 10, 12 times the amount of debt relative to equity. That's a reasonable leverage ratio. That's what we have in India. But I think that level of debt is necessary in order to give the borrower cheap finance. That if you had much less debt than that, finance to the borrower would become much costlier. So the arguments that there's no cost to having more and more capital requirements imposed on the banks, to my mind, is simply not sensible and has no bearing with the reality. So, let me conclude then, and happy to take questions. Debt is in many ways the most capitalist of contracts. Not so much because it is hard. Some people would say it's most capitalist because capitalism is a harsh system, and that's what debt is. No, I would say it's most capitalist because it allows for anonymity. It allows for an expansion of the sphere of people who can do business together. That's why it's the most capitalist. It allows, in a sense, a much broader area where people can engage. But there are downsides to debt. We've talked about that. They sunder bonds within the community. There's excess liquidation. There's debt overhang. And all these are very problematic for poor people who borrow, which is why the hatred for moneylenders across the world, and certainly in India. But it's hard to do without it, for all the reasons I've said. And so the real answer here is moderation. Some debt, but not too much. For example, today, we've asked the microfinance firms, when they lend to a poor borrower, to register their loan with the Credit Information Bureau. And once somebody has borrowed from more than two lenders, they should not borrow from more. A third lender who finds that this person has already borrowed from two should not make a loan to this person. It sounds paternalistic, but it is to avoid the overborrowing that we would otherwise get in the system, which would be really problematic. Similarly, for large firms, today we've created a database at the central bank, which didn't exist before. At the RBI, today we have a database which we share with all the banks. Who has this person borrowed from? How much have they borrowed? What is the status of the loan? Is it performing, non-performing, soon to be non-performing, etc. Okay? So these kinds of information sharing, as well as strengthening creditor rights, helps mitigate the problem of excess debt and overborrowing, which ultimately is problematic for a country. And finally, as far as India itself goes, one of the temptations during the period of easy money across the world, which is coming to an end if we believe all the commentary about the Federal Reserve in the next week or so, That easy money was a temptation for us. We could have borrowed enormous amounts. Countries in Africa suddenly increased the foreign share of government debt to 30–40%. Today in India, the foreign share of Indian government debt, which they really want to get into, is about 3.2%. We've kept it at this level simply because we don't want to be tempted by the easy money into overborrowing from the outside and getting into debt difficulties down the line. Similarly, we've said debt contracts that come into the country have to be minimum residual maturity of 3 years. Again, the hope is that when people have to invest for the longer term, when creditors want to invest for the longer term, they don't have the short horizons that would otherwise tempt them to overlend into the system and create difficulties for the system down the line. So in a number of ways, we're trying to address the principle that debt is good, too much debt is bad. And let's have, as always, a golden mean. Let me stop there, and happy to take questions. Okay.
Thank you, Dr. Rajan, for such an outstanding lecture. I think Presidency University is going to be in your debt for as long as we can remember. Thank you very, very much. Presidency University is also going to be indebted to Abhijit Vinayak Banerjee for persuading Dr. Rajan to come here today. Thank you, Abhijit. Thank you very much.
Well, just to interject at this point, one debt I did not acknowledge to Presidency is my mother studied here.
Now you know. Now you know. There was a connection. I would be amiss in my duties if I allowed the question-answer session to start without correcting a mistake in my introduction. My introduction said that the economics department in its golden era did a lot, and we had illustrious alumni and teachers. We may not be in our golden era today because it's all more competitive, very hard, and we struggle for lots of things. But I'm indeed blessed as a Vice Chancellor to have a wonderful, wonderful Faculty of Economics today. The young department, I call them young, it's one of our oldest departments, but the faculty, our median age is 35. They work hard, they soldier along, and I must compliment each and every member of our economics department faculty to do an outstanding job of persuading, of soldiering, of convincing me why they just must do better. My congratulations to Moushami Datta and her team. A round of applause. This is the very, very young Moushami Datta. I would also like to thank our students of the Department of Economics. They show their thirst for knowledge, they demand more, they activate for more. This makes us do more and more for them. May the spirit of the Department of Economics live forever beyond our 200th year, which is approaching in 2017. We are indeed very proud of all our economists, past, present, and future. Thank you all, and I would now like our third year UG student, Sharon Banerjee, to moderate the question-answer session.
So thank you for a very, very illustrious speech on debt. And so before I go into questions which are related to your lecture, we from the Department of Economics have a couple of questions for you. Sir, one of the questions would be, sir, in the aftermath of the 2008 financial crisis, we've seen that many basic and mainstream principles of economics have come under direct attack. So what would your advice be to a hall full of students and aspiring economists who are studying these very basic principles in their classroom but are also exposed to all of these heavy criticisms of redundancy in the outside world?
So, hello. Can you hear me up there? It's a very good question. The tendency at times like this is to throw everything out and say the world is, and you will see that what we throw out is often based on the political economy of the moment. So today, it used to be the case that the received wisdom before the financial crisis is don't distort prices and have light regulation. Today, for example, in the financial sector, the answer seems to be let's distort prices like mad, which central banks are doing across the world, and let's have very heavy regulation. Be wary about large swings in beliefs, because often they're wrong. There is something to be said for the old, but it missed out something. There's something to be said for the new, but it misses out something. The mean is somewhere in between. This is actually a point that Hirschman, I think, made a long time back, which is we tend to swing from one pole to another, rather than stay somewhere in the middle. The middle is rarely an attractive place to be, especially for radicals of either side, because the middle often requires, trade-offs, judgments, is often much more nuanced. My definition of a populist is somebody who proposes simple solutions to everything and who doesn't recognize that the world is a really complex place. And I think we are today in the world of populism, whether populists of the left or populists of the right, who always have this simple, clear, and absolutely wrong solution to everything. Right? So let's avoid that. Recognize that perhaps we had under-regulated pre-financial crisis. There's some value to regulation. But recognize there's some value to getting prices right also, that distorting prices in a significant way eventually leads to a misallocation of resources and long-term harm. And let's golden mean.
Thank you, sir. There was another question which probably came in consensus from across the departments, was what led Raghuram Rajan, the engineer, to go into policy making and economics?
I actually, before I left school, I took what was then called the National Talent Exam. I don't know if it still exists, NSTS, but I studied the social sciences for the National Talent Exam. And I came across the work of Keynes and thought, wow, this is interesting stuff and so on, and I wanted to do that. But then the pressures of middle class life sort of weighed on me, and I took the science stream in school. And if you take the science stream, the next option is to sit for the IIT exams. And while I wanted to perhaps do a degree in economics from a good university in India, once you get through the IIT exam after expending so much effort, it seems like you really should go and take it up, because nobody else is crazy enough to leave the IITs and do something else. Sorry to all the economics students here, not a slur on you. So I got into the IIT Delhi, was doing electrical engineering, and somewhere in my third year when I was dealing with fields and waves, I said, is this really what I want to be doing in life? Working with something which doesn't talk back, which has I don't have a feeling for. That's when I decided that I should probably do something like economics and policy.
we'll open up the floor of the House to questions. Are there any questions from the audience? There will be a lot of questions, so we'll probably start in order from the guests. Sir.
Dr. Rajan, I'm Dr. Nirmala Mukherjee from Bengal Chamber of Commerce. Thank you for a wonderful speech, especially on debt, because we live in a state which is debt-ridden, and that's very important. So my question is, only yesterday you put up 150 truant companies for SDR. SDR, strategic debt restructuring. Okay. Now, when a state is really struggling to go ahead and debt comes in its way, it is happening here. Every year, we are paying 28,000 crore, an inherited financial mess. Everybody knows about it. Now, the point is then debt politics or is it economics? Can your monetary issues really go into fiscal matters? Because this is a fiscal issue. And you are playing a very important role, very, very important role as a regulator. So if it is politics, it is a separate issue. What you discussed, it's some part is known, some part is unknown, but you discussed economics. So we from the Chamber of Commerce, we are very, very intrigued as to how to go about with it, because we also do want that this state should go ahead, and there are industrial jobs because of this debt. Thank you very much.
Thank you for the question. First, there are 150 firms under the SDR. There are at this point a handful of firms. But there are 150 firms plus who are in various forms of restructuring, and perhaps that is the number that you have in mind. But the real question you have is, let me take it outside the current context, because I don't want to be commenting on this situation without the comments could be taken out of context. Is there a situation where a state, a country could be over-indebted in such a way that it makes it difficult for economic activity to take place? And the answer to that question is yes. I mean, Greece was a situation where it was over-indebted. There was no hope that it could pay the amount of money that was required from Greece, and therefore writing down the debt was probably wise in order to allow Greece to both survive as a country, but also for the lenders to get the maximum possible without killing the country, right? So even in the lenders, for the lenders sometimes it's in their interest to write down the debt. Now, where we are in West Bengal, whether we are in that kind of situation, I don't know. We need to do a proper debt analysis to see what the appropriate level of debt is. From the concern of creditors in the international situation, why is debt forgiveness harder, is that they often worry about other countries. So in the Greece situation, a number of lenders within the European Euro area wondered that if Greece got too good a deal, would the borrowers in Ireland, would the borrowers in Spain and Portugal start saying, give us that same deal even though they could service the debt? And moreover, could it encourage other countries to overborrow knowing that they wouldn't have to repay? So again, it's a difficult trade-off. On the one hand, you want to revive the local economy. On the other hand, you also want to avoid moral hazard where somebody overborrows knowing they don't have to repay. That trade-off has to be played well. I don't know what the situation is in West Bengal on these parameters exactly to give you an opinion.
Thank you, sir. Questions from any of the guests first, because we'll go into descending order of importance from guests. Just before you ask your question, since we're running on a time constraint, if you could just keep it short and precise.
Yeah, sure. Good evening, sir. Vedant from Area from St. Xavier's. So my question is, seeing the fact that the government wants more money rolling in the economy, wouldn't it be a good idea to cut down the FD rates that the bank provides, like it happens in the US, so that people instead of depositing their money in the bank would instead invest in the share market?
You want to cut interest rates significantly so that people will invest in the share market.
Yes, as it happens in the United States.
Well, that's where I talked a little bit about distortions. Do you really want to feed the share market in a way that it booms, but booms perhaps more than it should? I don't know. One of the concerns about having rock bottom interest rates and seeing asset price inflation, which is what you're advocating, whether it's be houses or whether it's share markets, is asset prices that boom have to come down at some point. And the poor fellow who invests at the last minute may suffer the consequences of the bust. In general, I don't think it's a good idea to generate growth through what is called the wealth effect, getting people to feel wealthier so they go out and consume, because often that wealth effect is temporary rather than permanent. If you can generate a permanent wealth effect, that's good, but I think that comes from increased real activity rather than increased prices of financial assets. That is why getting sustainable growth through a measured reduction in interest rates consistent with what inflation will allow is a much better way to engineer long-term growth rather than asset price booms, which will create much more havoc when they burst.
We are running currently short of time, so I've been told to invite Professor Abhijit Banerjee onto stage, sir, to share a few words with us.
Hello. Sir, can I ask you one question, sir?
Somebody wants to ask one question. Okay.
Sir, one question.
Last question.
Okay. Thank you, Dr. Rajan. We are very grateful for your vast presence. So I would like to ask you one question. That there are a lot of discussion on GST.
On
GST, yes. So is it really going to be a game changer in Indian economy? And today in a Bengali daily, I read that by introducing a GST, there likely may be some law on federalism, state federalism. So is it really good for Indian economy, or there are a lot of things we are hearing? So is it really going to happen by introducing this GST? That is my question.
So if you are asking my opinion on whether GST is by and large a good thing for the country, absolutely. And I think passage of the GST bill, of course there's discussion about the details, but broadly the two big effects it will have are, one, it could, in many countries where it's been implemented, increase the tax take, partly by bringing more people into the tax net, not so much by increasing the tax rate, but by bringing more people who are not paying taxes into the tax net. I think that's very good for India. Everybody should pay their tax burden and share the many needs that the country has for revenues. That's one. But the second thing, which is as important if not more important, is reduces barriers between states, unifies the country as a whole and makes it one common market. And it's high time we were a one common market, that we were a country where going across borders doesn't require significant transaction and tax costs. And that, I think, would be as big an advantage as the improvement in revenue generation.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.